All right, let's talk about Acadia Pharmaceuticals. They just reported their third quarter numbers, and wow, on the surface, they looked incredible. But as the market started to dig in, it became pretty clear that the real story here is all about the quality of that earnings beat. This is a perfect example of why you've always got to read past the headlines. So this is the number that got everyone's attention right out of the gate. A massive plus 200% surprise on GAAP earnings per share compared to what analysts were expecting. I mean, when a number like that hits the screen, you're thinking the stock's about to take off. And just look at this chart to see how huge that beat really was. The street was looking for about 14 cents a share. Acadia comes in and delivers 42 cents. That is a threefold beat, an absolutely incredible performance that, at first glance, sent a super bullish signal to investors. But the real question is, was it sustainable? To answer that, we really need to pop the hood and deconstruct this quarter. You see, the company's performance was basically driven by two key products, and one very, very significant item that wasn't really related to the core business at all. Now, what's really interesting here is that the core business, it's actually quite strong. The top-line revenue, so total sales, came in at almost $279 million. That's a solid 11% jump from last year. And both of their main drugs are firing on all cylinders. NUPLAZID was up 12%, and DAYBUE was up 11%. So this is a healthy two-engine growth story for sure. And on the earnings call, management's story was, as you'd expect, very confident. The CEO talked about solid execution and hammered home the company's goal to cross that $1 billion sales mark by 2025. The message was loud and clear. Our core business is strong and getting stronger. And this brings us to the million-dollar question, the one that totally flipped the script on the stock. Can they actually repeat this kind of bottom-line performance? Because once analysts started digging into the details, the quality of that massive earnings beat came under some serious scrutiny. Okay, so here's the kicker. That incredible 200% beat, it was supercharged by a one-time tax benefit, something they got from new rules about R&D expenses. If you strip that out, the beat looks way, way more normal. On top of that, sharp analysts, like the team at RBC, started flagging some softness under the hood. Things like weaker sales volumes from Medicaid patients and a higher bad debt expense. These are exactly the kinds of details that separate a high-quality beat from a low-quality one. So, with a kind of questionable beat in the rearview mirror, the next question is, where does the company go from here? Let's take a look at their guidance and strategy, because it's pretty clear they're focused on one thing: investing for growth. Now, despite all that noise on the bottom line, management showed some real confidence in the business by actually raising its full-year revenue guidance. They bumped up the forecast for total revenue and specifically for their main drug, NUPLAZID. This signals that they believe the sales momentum they saw this quarter is real and is going to continue. And honestly, this is the heart of the bull case for the stock. And they're not just talking a big game, they're putting their money where their mouth is. The company announced a pretty major strategic move. They're going to expand the NUPLAZID sales force by 30%. That is a significant investment aimed at grabbing more market share. They're also moving their pipeline forward and just hired a new strategy chief, which kind of hints they might be on the hunt for acquisitions. The key takeaway here is they are not sitting back and collecting cash. They are spending aggressively to grow. So you've got this big headline beat, but with some serious quality issues under the surface, plus a plan for heavy investment. So how did the market react to all this? Well, it led to a very telling and, frankly, a very confusing reaction. Let's break down how investors processed all this news. This timeline just perfectly captures the whole debate. So the stock closes around $22.33 before the report. Then, after hours, it pops higher on that awesome headline beat. The next morning, it keeps running, hitting an intraday high of almost $23.60. But then, as investors and analysts actually digested the details, the low-quality beat, the heavy spending plans, the stock completely reversed course and actually closed down 3%. It's the absolute classic pop and fade. So let's just boil this entire debate down into a nutshell. The bull case is really simple. This is a growth story, sales are accelerating, they raised guidance, and they have two really strong drugs on the market. The bear case, on the other hand, is all about quality and risk. That EPS beat was flattered by that one-off tax benefit. You've got some headwinds with patient insurance mix, and that big sales force expansion adds a ton of cost and, of course, execution risk. So balancing that strong top-line growth against a noisy bottom line and some future risks, what's our call? Where do we think the stock goes from here as we head into the next quarter? Our call is a market perform rating. Ultimately, we think the market's pop and fade reaction pretty much got it right. At this price, the potential reward from that strong growth seems pretty fairly balanced by the risks of higher spending and whether or not they can execute. And here's why. Look, you absolutely cannot ignore the strong sales performance and the raised guidance. Those are real, undeniable positives. However, the low quality of that earnings beat just makes it really hard to get excited, and that 30% sales force expansion is a big gamble. It could definitely accelerate growth, or it could just bloat their costs with not much to show for it. Right now, the market is correctly taking a wait-and-see approach, and so are we. So if you agree with that wait-and-see view, how might you trade it? Well, here's an idea. The thesis is that the next few quarters are all about one thing: execution on that sales force expansion. The big catalyst will be the Q4 report and their guidance for the next year, which will give us the first real data on whether this big investment is paying off. So the trade could be a pairs trade. You go long Acadia stock and you short the XBI, which is a big biotech ETF. By shorting the broader biotech sector, you can kind of hedge out industry-wide swings and really just isolate your bet on Acadia's specific performance, whether it's good or bad.
This is not financial advice.